Hey, if you're thinking about starting an Airbnb business and you want to run some numbers to figure out what's it going to take to start up, how much money could you make, how much money could you lose, and just really all the numbers behind what goes into starting and operating an Airbnb business, then this video is for you. We have developed a financial projection template built specifically for Airbnb businesses, and we're going to walk you through how to use it here today. My name is Adam Huxema, and I'm the co-founder of Projection Hub. We've helped thousands of entrepreneurs create financial projections for potential investors, lenders, or just for internal planning. And so really excited about this Airbnb template. And you can find a link to the template in the description of the video below. And now we're just going to dive in and show you how it works. So the first thing you need to know about this template is that any cell that's highlighted in blue is an assumption that you can change without breaking something in the template. I'm just going to walk through the assumptions that we have put in here and show you the results. So we've got Adam's Airbnb empire here, and we are assuming that we're going to have to put in a personal investment of $150,000 here to get started. And that is going to be used to help purchase property, as well as outfit it with furniture and just have working capital for the business. So you put in your initial investment here. There's a table here where you can put in fixed assets other than the rental properties themselves. So what I put in here is just the furniture that I would expect that we may have to buy for each additional Airbnb unit that we purchase. And this could be furniture and appliances as well. So, washer and dryer and refrigerator that you may need as well. Okay, so here's where we're going to put in the properties. And so what we've done here is we've got property 1 is a single unit Airbnb. We're saying that there's one property, we purchased it instead of leased it. So we purchased it. Our purchase price is $300,000, and that's the purchase price plus the renovation. So if you are purchasing a property and then renovating it to list it on Airbnb, I would go ahead and put the full purchase plus renovation price here. And you'll see that I put useful life of 30 years and salvage cost per property of $300,000. So what I'm doing here is just assuming that there's no depreciation. Hopefully the value of the property goes up. If we depreciate the property, it's going to kind of throw off the projections. You're going to show a net loss, even though depreciation is a non-cash expense. And so I just put it as the same dollar amount so that depreciation doesn't really throw us off. Now, we're saying that we've purchased this in month 1 and that we're able to get a loan for $210,000 to finance the property. So, based on our research, looks like if you're able to get a loan to purchase an investment property, you're going to have to put in probably 30%. So up here in the equation here, you can see that we're taking the purchase price here times 0.7. So 70%, that's what you're going to be able to finance probably. And this can vary depending on, your credit score and your situation and your personal financial situation. But that's what we're assuming here. We're assuming an interest rate of 5% and a 30-year mortgage, 360 payments. So, and then what we've done here is we're saying that, okay, our second property number 2 is going to be a multi-unit property for $500,000 that we're buying, and we're going to buy that in month 11. And we're going to, again, finance 70% of that. And then our property number 3, we're going to buy a large unit Airbnb for $500,000. We're going to buy that in month 23, so the end of year 2, and finance 70% again. And then just as an example, so property number 4, let's say, okay, you can't keep buying properties, you're running out of down payment here, and so you want to keep growing the empire here, so you could lease a property from somebody else that you would then operate as an Airbnb. And so you have the ability to to either purchase properties to operate or lease them. And so if you select lease, then it's going to kind of black out the section, the purchase price property, and the other sections are irrelevant. So we're saying that we lease this property in month 35, and we are paying $1,400 per month in rent to lease that property. All right, so now based on those assumptions, we're going to come to our input revenue tab. And so this is going to pipe in those 4 properties for you into this table, and then you can select here what month you're going to be able to start renting it out. So basically what we did here is we just took the month that we purchased it and we added 2 months to it. So we're saying in 2 months after we purchase or lease a property, that's when we can start listing it and actually generating income. So we're saying in month 3 of the projection, that's when we start renting. And there's only 1 unit available in that first property to rent. And we are assuming monthly rent, the potential for monthly rent is $4,200. And I would suggest that you use airdna.com to get an idea of the rent potential of the properties that you're looking at. So it's a really cool website. You can go there and you type in a particular city, for example. You type in a city and it will show you the average, a number of data points, but it will show you the average rent per month, the average nightly rent that people are generating. And it'll also show you seasonality, so you can see how that changes with time, as well as you'll be able to see the average vacancy rate for properties like yours in your city. So lots of great data. You can go there and then fill out these assumptions based on what you learn from AirDNA. So I'm assuming that our first property is going to be vacant 25% of the time, which means it's going to be used 75% of the time, which may be pretty aggressive. But let's say we're really going to get aggressive with this business, and so we want to list it to be used. And so you can see then your monthly revenue per property based on those assumptions. And you'll be able to enter in a utilities cost per month, an insurance cost, maintenance costs, property taxes, and any other costs per month that you have associated with that specific property. And you'll be able to come up with your total cost per month. Now jumping over to our input other expenses. So here we can put in other fixed expenses or variable expenses that we have in the business that aren't necessarily tied directly to a particular property. Or if you have expenses like cleaning expense, where it's not necessarily specific to any individual property, it's just every unit is going to need to be cleaned. And so we have here an assumption of a per unit cleaning cost of $250 per month, a per unit or here per property. So you can do per property or per unit. So if you have a multi-unit property, each unit's going to need to be cleaned, but that property only has one lawn, right? And so you can do expenses on a fixed basis, a per property, a per unit, or a percentage of revenue basis. So a lot of flexibility here. Again, same thing with like internet and security. Those may be per property expenses instead of per unit. You can put those expenses in here. And then here we can say, okay, once this Airbnb empire gets up to a certain level, maybe we need to hire a property manager part-time. Maybe you're doing that yourself in the early days as you're building up the business, but here we show a part-time property manager making $20,000 a year just as a part-time job, starting in month 49, so at the end or the beginning of the 5th year. We're gonna hire this property manager. So once we enter in all of those assumptions, we're able to see our profit and loss at a glance and a number of useful data points of per property and per unit data use of startup funds, startup capital required. And you can see, look, you're losing money. You have a net loss in year one as you build up. And you can see over time, I mean, you've got a significant amount of dollars invested into the business, and we're still not just raking in net income here, but I think a big thing for a lot of Airbnb owners is the question of whether the property also increases in value as well. And so that's probably where the big returns come for folks is, if you can generate a profit by operating the Airbnb business, as well as owning and holding that real estate, paying off the debt service on that real estate while you operate the Airbnb, and then, increasing the equity value of the property over time. That's really where the return on investment is probably going to come from. So, of course, you can operate the business, maybe more efficiently or more profitably than the assumptions that we've put in here. But I think our assumptions, are relatively aggressive already. And so just be aware, go through, and before you put down $150,000 down payment on your new Airbnb property, make sure that these numbers work out. Know what you're getting yourself into. If you have any questions, please don't hesitate to comment in the comment section of the video below, or reach out to us if you need help filling out the template. Support@projectionhub.com. We'd be happy to help.